You sell your house in New York, congratulations, you made money, you built equity, you're ready to move on. And then the government shows up. Transfer taxes, city and state, capital gains, state income tax, city income tax, net investment income tax. It stacks up very quickly. On a typical $750,000 sale in Staten Island, sellers can lose anywhere from $14,000 to over $100,000 in taxes, depending on the situation. And most people have no idea until they see the closing statement. So today, I'm going to break down every single tax you face when selling a home in New York, and more importantly, how to legally keep as much of your profit as possible. I'm Joseph with the Bridge and Boro Team at Real Broker. I sell homes in Staten Island and Brooklyn every single week. I've closed hundreds of transactions, and I've seen sellers get blindsided by their tax bill because nobody took 10 minutes to explain this stuff in advance. Now, I will say, of course, I am not a CPA. I am not in the tax realm, so you must always confirm this stuff with your tax professional before making decisions, but I would like to give you the framework so that you can walk into that conversation informed. Today is just going to be plain English. Real numbers, no jargon, okay? I have almost 80 at the time of this video, 5-star Google reviews from people I've helped navigate exactly this. And the number one thing sellers tell me is, I wish I had known this sooner. So let's make sure you know right now what to look for when this comes up. Now, before we get into the numbers, I put together a free New York City seller tax guide that has every single number from this video, plus a net proceeds calculator where you can plug in your sale price, purchase price, and see exactly what you would walk away with. It is totally free. Link is in the description and pinned comment. Grab it now so you can follow along. So let's start with transfer taxes. These hit every single seller regardless of profit. You really can't avoid them. They are based on the sale price, not your gains. In New York City, sellers pay a transfer tax of 1% on sales under $500,000 and 1.425% on sales at $500,000 or above. On top of that, New York State is going to charge you an additional 0.4%. So let's do the math on a $750,000 sale, which is right around the Staten Island median right now. Brooklyn median is pushing 900, a million, so that's going to be higher. New York City transfer tax at 1.425% equals $10,687. New York State transfer tax at 0.4% equals $3,000. So combined, $13,687 gone before you even think about capital gains. For homes selling at $3 million or above, which is not that rare in our city, the state rate jumps to 0.65%. But for most Staten Island and Brooklyn sellers, we're going to be talking about that 1.825% combined rate on sales over $500,000. That's your most common sales in both boroughs. So one important note is that the mansion tax is often confused with seller transfer tax, but the mansion tax is paid by the buyer, not the seller. That's their problem, not yours, unless you are selling and buying something over $1 million yourself. Then you will be applicable to pay the mansion tax as well. That's kind of outside of the scope of this video because we're talking mainly about what sellers will pay. Now here's where it gets complicated and where the real money is at stake: capital gains tax. Capital gains is the tax on your profit, the difference between what you paid for the home and what you sold it for, minus qualifying improvements and selling costs. At the federal level, long-term capital gains, meaning that you own the property more than 1 year, are taxed at either 0%, 15%, or 20% depending on your income bracket. Most middle-income sellers land at that 15% rate, just for some context. But here's where New York gets you. New York State has no preferential rate for capital gains. It's taxed as regular income at rates from 3.9% all the way up to 10.9%, which is brutal. If you live in New York City, which is my typical base, add another layer. New York City income tax is up to 3.876%. And if your modified adjusted gross income is above 200,000 single or 250,000 married, there's the net investment income tax, which is an additional 3.8% on top of everything. Now, add all of those up for a high-income New York City resident, and you're looking at nearly 39% of your profit going to taxes. So that's why the next section is the most important part of this entire video. The Section 121 exclusion is the single most valuable tax benefit for homeowners in America, and most people either don't know it exists or don't fully understand how it works. So here's the deal. If you've owned and lived in your home as your primary residence for at least 2 out of the last 5 years before selling, you can exclude up to $250,000 of capital gains from taxes if you're single, And if you're married filing jointly, that jumps to $500,000. So let me say that again. $500,000 in profit, completely tax-free if you're a married couple selling your primary home and it falls under these parameters that I just mentioned. For most Staten Island and Brooklyn homeowners, this exclusion covers their entire gain or most of it. So think about it. The median home in Staten Island is around $750,000. So if you bought that home 10 or 15 years ago for, let's say, $400,000, your profit's $350,000. If you're married, Section 121 covers all of it. You're going to pay zero capital gains tax. The requirements are simple. You must have owned the property for at least 2 years. You must have used it as your primary residence for at least 2 of the 5 years before the sale. And you can only use this exclusion once every 2 years. There are some special cases, partial exclusions for job relocations, health changes, or unforeseen circumstances. Talk to your CPA about those, but for the vast majority of sellers that I work with, Section 121 wipes out the capital gains a very nice degree, if not entirely. Now, let me walk you through a real-world example. A married couple selling their primary residence in Staten Island for $750,000. They bought it 12 years ago for $450,000. They've lived there the entire time. So sale price, $750,000. Original price, $450,000. Capital gain, $300,000. Section 121 exclusion for married couple, yes, $500,000. Since their gain is only $300,000, it is fully covered. Capital gains owed are zero. But don't confuse that with transfer taxes. Again, the number that we're at, New York City, 1.425%, $10,687, New York State, 0.4%, $3,000. So you still have $13,687 in transfer taxes. But on a $750,000 sale with $300,000 in profit, this couple walks away with roughly $286,000 in tax-free profit after transfer taxes. It's not bad. Now compare that to a single person who inherited the property and doesn't qualify for Section 121. Same $300,000 gain, they could owe $45,000 or more in combined federal and state capital gains taxes, plus that $13,000 in transfer taxes. That's nearly $60,000 of a difference. So this is why understanding these rules before you sell is critical. Now, a few strategies worth discussing with your tax professional. First, track your capital improvements. Every dollar you spent on renovations, new roof, kitchen remodel, bathroom upgrade, finished basement, gets added to your cost basis, which reduces your taxable gain. So keep those receipts. If you're just buying a home right now, you're not going to think about selling for 10, 20 years, still just keep it in your mind. Keep every single receipt, and then just throw a folder on your CPA's desk in 20 years and save tens of thousands of dollars. Okay, second, timing matters. If you're close to that 2-year primary residence requirement for Section 121, waiting a few months could save you 6 figures. Don't rush a sale and miss the exclusion. Third, if you're selling an investment property that doesn't qualify for 121, look into a 1031 exchange, which is deferring your gains into another investment property. That's a whole separate video, but it is very powerful. Fourth, selling costs reduce your gain. Your broker commission, transfer taxes, attorney fees, staging costs, all of these reduce your taxable profit. Now, something else that should be said, there is an entire other tax strategy. It's very advanced, but that will help you with, if let's say you do have a heavy capital gains tax, this will require its entire own video, probably a whole video series. But if let's just say you have $1 million in capital gains tax, reach out to me because I just learned about something really cool that you could use. Now look, I know taxes aren't the most exciting topic, but I have seen sellers leave $50,000 or more on the table because they didn't understand these rules before they listed. The smartest move you can make is running these numbers before you decide to sell. Know what you'll owe, know what exemptions you qualify for, know what your actual net proceeds will be. If you want me to run through your specific situation, I do free consultations. We'll look at your purchase price, your estimated sale price, your filing status, and I'll show you roughly what you'll walk away with. No obligation, no pressure. Of course, take that, verify it with a CPA. I'm just giving you the frameworks of what exists. The link to book is in the description, and grab that free New York City Seller Tax Guide. It has a calculator that does all of this math for you. Again, I'm Joseph with the Bridge and Boro Team. If this was helpful, smash that subscribe button. Drop a comment below. I read and reply to every single one. I'll see you in the next video.